All right, if you're here, you're probably sensing it already. Something just snapped. I want you to hit pause on whatever headline you just saw and really hear this because in the last 24 hours, silver didn't just dip, it fell off a cliff. We're talking about a minus 21.5% move from roughly $120 an ounce down to about 97, and that single day move erased around 1.4 to 1.5 trillion dollars in notional value. That doesn't happen in calm markets. And here's the part most people are getting wrong. This wasn't about demand disappearing overnight. Both major futures desks and physical dealers are saying the same thing right now. This was forced. Stay with me, because I'm going to show you why this kind of move usually shows up near turning points, not endings. If you're watching this now, you're ahead of the noise. Your job is to understand what actually happened, not what the panic merchants are selling you. Before I explain what caused this, let me teach you something that will save you pain in future markets. Most people don't understand that price isn't just about value, it's about positioning. Think of the market like a crowded theater where everyone's leaning forward to see better. It works fine until someone trips. Then it's not about who wants to leave, it's about who's forced to move. When prices go vertical, leverage piles in quietly. Futures, options, synthetic exposure, it stacks up invisibly. So when you see a 20% move in one day, your first question shouldn't be what changed. It should be who got forced, because fundamentals don't change by 20% in 24 hours. Positioning does. That's the concept you need burned into your brain. Markets don't move on opinions changing, they move on obligations being enforced. So, what does that tell us? It tells us that when you see violent price action, you're not watching a referendum on value. You're watching a margin call in real time. If this is making sense, drop a comment below and let me know where you're watching from, because I want to know who's actually paying attention to structure instead of just reacting to headlines. Now, here's what's actually happening, and let me break down the sequence for you step by step. Silver ran parabolic. Not healthy momentum, parabolic. That invited extreme leverage, especially in paper markets. When price started to roll, margin thresholds got hit. That's the trigger. Once margin calls go out, traders don't debate narratives, they liquidate. That selling pushes price lower, which triggers the next layer of margin calls, and suddenly you're in a cascade. It's a domino effect, but the dominoes are financial positions worth billions. Here's what's wild about this. The selling feeds on itself even as physical demand stays intact. So when price drops from 120 to under 100 an hour, that's not people changing their minds, that's math enforcing discipline. Let me give you the proof. Futures desks have already confirmed liquidation volumes spiked. Physical premiums, especially in Asia, barely budged. That divergence matters. Because when paper collapses but physical stays bid, you're watching leverage unwind, not value evaporate. Now let me layer in the secondary confirmation because this gets even more interesting. The options market had been building up massive open interest on the call side. When silver was at 110, 115, 120, people were piling into calls expecting more upside. Those positions create what's called gamma exposure. Without getting too technical, it means dealers who sold those calls had to buy more silver as price rose to hedge themselves. That creates an acceleration effect on the way up. But here's the thing, it works in reverse too. When price starts dropping, those same dealers have to sell to rehedge. So you get mechanical selling pressure that has nothing to do with fundamentals. It's pure positioning dynamics. And that mechanical selling hit at the exact same time margin calls were going out. You had two types of forced selling converging at once: leverage liquidation plus gamma dehedging. That's why the move was so violent, so fast. And here's the convergence proof that ties it all together. Normally, when an asset drops 20% in a day, you'd expect physical markets to crack. You'd see premiums collapse, dealers pulling back, retail panic selling. That's not what happened. Reports from Singapore, from Hong Kong, from India, they're all showing the same thing. Physical premiums held firm or actually rose slightly. Retail demand didn't vanish, it shifted from FOMO buying to opportunistic buying. That tells you something critical. The real economy participants, the people who actually use silver or hold it for long-term reasons, they didn't change their view overnight. They're watching paper markets implode and thinking, this is a gift. That divergence between paper panic and physical stability, that's your signal. That's how you know this was structural unwinding, not fundamental deterioration. But here's the part that should make you nervous if you don't recognize it in real time. These moves feel like the world is ending right before the pressure releases. I've seen this movie before, and so has anyone who's been in markets long enough. Your chest tightens, your conviction wavers, you start second guessing everything you thought you knew. That's the point. That's when weak hands capitulate, and that's exactly when smart money starts positioning for what comes next. This is the exact same playbook the market ran in 2008. Let me take you back. Silver had run from around $13 to over $20 by March of that year. Leverage was extreme. Then the credit crisis accelerated in September and October. Silver got crushed. It dropped from around $14 down to under $9 in weeks. Violent, brutal. Headlines everywhere screaming the end of commodities. What happened next? Once the forced selling exhausted itself, silver bottomed in late October and began one of the most powerful runs in its history, eventually hitting $49 by 2011. Same pattern. Parabolic move, leverage saturation, liquidation event, then repricing higher from a cleaner base. It showed up again in 2011. Silver hit that $49 high in April, then collapsed to under $26 by September. 50% drawdown in 5 months. Margin requirements got hiked multiple times. Forced liquidation everywhere. People swore silver was done, that it was all manipulation, that fundamentals didn't matter. And you know what? They were half right. It was distorted. But the pattern still played out. The leverage got flushed, price stabilized, and while it didn't make new highs immediately, it built a base that held for years. And it showed up almost perfectly in March 2020. Remember that? Silver was around $18 in late February. By mid-March, it had crashed to under $12. Everything was being liquidated to raise cash during the pandemic panic. Gold got hit. Oil went negative. Treasury bonds, the safest assets on earth, were being dumped. That wasn't about fundamentals. That was about margin calls and redemptions forcing indiscriminate selling. What followed? Silver went from $12 to nearly $30 over the next 5 months. Every time you see the same rhythm: parabolic run, leverage saturation, liquidation event, stabilization, then either a real breakdown or a powerful reprice higher. The larger story is that these events tend to cluster near inflection points, not at quiet, rational tops. Markets don't end politely, they end loudly, then they rebuild. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Of course it could. There's no rule that says 97 is the bottom. Silver could break 90, could test 80, could go lower than anyone expects. I'm not sitting here telling you the bottom's in. And let me be honest about manipulation claims too. Yes, paper markets are distorted. Yes, concentrated short positions exist. Yes, it's frustrating. But here's the thing, it doesn't actually matter whether there's a villain pulling strings or whether it's just algorithmic cascades and market structure. The mechanics are what matter. What matters is whether selling pressure is still forced or becomes voluntary. What matters is whether physical markets stay firm or crack. You can't control narratives, but you can control your time horizon, your leverage, and your patience. That's where the edge actually lives. Focus on what you can verify and what you can control. There are probably three types of people watching this right now. First, there's you if you got shaken out today. If that's you, don't beat yourself up. Forced selling is designed to feel personal. It's designed to make you feel like you missed something obvious, like you were the only one who didn't see it coming. You weren't. This caught everyone off guard, even people who expected volatility. The lesson here isn't shame. The lesson is position sizing and leverage awareness. If a 20% move in a day forces you out, your position was too big or too leveraged for your risk tolerance. That's information you can use going forward. It doesn't mean you were wrong about silver. It means you need to adjust how you hold it. Second, there's you if you're holding and staring at red, wondering if you're missing something. You're not crazy for noticing fundamentals didn't change overnight. Debt didn't disappear. Monetary policy didn't shift. Industrial demand didn't vanish. Your decision now is about time horizon, not headlines. If you bought silver because you believe in the long-term structural case, ask yourself honestly, did that case change? If the answer's no, then this is noise. Painful noise, yes, but noise. If the answer is yes, if you're realizing you bought for momentum and not conviction, then maybe this is your chance to reassess. Either way, be honest with yourself about why you're in and whether that reason still holds. Third, there's you if you're waiting, cash on the sidelines, thinking this might be an opportunity. That's valid too, but patience matters. Let the market prove it's done panicking. Don't try to catch the falling knife just because it's falling. Wait for signs of stabilization. Wait for volatility to compress. Wait for forced selling to exhaust itself. The opportunity will still be there if this is real. And if it's not, you'll have protected your capital. For all of you, the universal rule is the same. Don't let mechanical events force emotional decisions. Take a breath, assess the data. Make choices based on your plan, not the panic. So here's what I want you to answer in the comments. Are you holding, buying, or waiting? And more importantly, what signals are you watching to make that decision? I want to see how you're thinking through this because that's what separates people who survive these events from people who get wrecked by them. Here's where I stand. I'm not panicking and I'm not blindly buying either. I'm watching three things very closely. First, I'm watching whether silver stabilizes in the $95 to $100 zone and stops making lower lows. If it can hold that range for a few days without breaking down further, that tells me forced selling is exhausted. If it breaks below 95 with volume, that tells me there's another leg down coming and I need to be patient. Second, I'm watching whether volatility compresses instead of expanding further. You can see this in the VIX for silver if you track it, or just in the daily ranges. If ranges start tightening, if the panic spikes start fading, that tells you forced selling is ending and price discovery is starting. If volatility keeps expanding, if we keep seeing 10 or 15% moves daily, the liquidation isn't done. Third, I'm monitoring physical premiums, especially in Asia. In past cycles, elevated premiums preceded sharp upside repricing. When physical markets decouple from paper and stay firm, it means the real demand base hasn't cracked. That's your foundation for a recovery. Based on my analysis, this move was structural and mechanical, not a sudden rejection of silver's roller demand. The fundamental picture didn't collapse. Leverage did, debt levels didn't shrink, central bank balance sheets didn't reverse, industrial demand for solar, electronics, EVs, that didn't evaporate, investor concern about currency debasement, that didn't vanish. What happened was a highly leveraged speculative position got hit with forced liquidation, and the mechanics of margin calls created a cascade. That's a technical event, not a fundamental one. If history rhymes and silver stabilizes above 95 and then reclaims 100 with conviction, the move that follows could be significant. I'm not making predictions. I'm watching structure. Now, I'm not a financial advisor. This is not financial advice. Everything I've shared here is my personal analysis and opinion. Do your own research. Verify the data yourself. Make decisions that fit your situation, your risk tolerance, your time horizon. Don't take my word or anyone else's word as gospel. If you made it this far, you're in the top 1% of people actually trying to understand markets instead of just reacting to them. That mentality, that discipline, that willingness to learn structure instead of chasing headlines, that will serve you well. Whether it's silver, whether it's equities, whether it's anything else, the principles are the same. Understand positioning. Watch for forced moves. Be patient. Protect your capital. Hecht. If this breakdown helped you see what's really happening, share this video with someone who needs to hear it. Subscribe if you want more real analysis when markets move, and stay ahead of the noise. Think critically, verify the data, and make decisions that serve you, not the panic. Stay sharp out there.